Right now, shares of Nuburu Inc. are trading at $0.40, marking a significant intraday jump of 0.059 or 17.27%. When you see a microcap stock, one trading well under $1, make a move that aggressive, the immediate assumption, the expectation, is that some transformative news has hit the wires. And in this case, that expectation is technically correct. The market is digesting a major announcement from a few days ago, a strategic move into the defense sector, specifically advanced drone systems through a new joint venture. This news paints a picture of a company grabbing hold of a massive, multi-billion-dollar market. But here's the reality that isn't reflected in that 17% pop. This news is landing at a company that is fighting for its corporate life. This surge isn't just about a new opportunity, it's about a desperate pivot away from a financial situation that can only be described as dire. What we are witnessing is the profound tension between a compelling, forward-looking press release and a balance sheet that screams going concern. This isn't a story about a healthy company expanding, this is a story about survival. Let's first look at what is driving the volume and the optimism, because it is significant. This excitement is being fueled by the announcement of a strategic framework agreement with Maddox Defense. The plan is to establish a joint venture company controlled by Nuburu's subsidiary, Nuburu Defense. This new entity is being set up to design, manufacture, and deploy advanced drone systems for both military and commercial use. The headlines this generated are precisely what traders on the Robinhood app or a SoFi Invest platform look for in a speculative play. The company is targeting the NATO UAV defense market, which they estimate at a staggering $7 billion to $10.3 billion annually. More than that, the joint venture is putting out some very specific projections. They anticipate reaching approximately $100 million in annual revenue by the end of 2028. For a company whose current stock price is measured in cents, $100 million in revenue sounds like a fantasy. This is the narrative that has traders hitting the buy button. It's a complete shift in the company's story, aiming it directly at the defense and security sector, a space that has seen significant investment flow, far removed from its original industrial focus. This move is part of a broader and very recent transformation plan being led by its executive team. This isn't just one announcement. On October 7th, the company announced a binding agreement for its defense subsidiary to acquire Orbit SRL, an Italian sauce provider focused on operational resilience. This, combined with the Maddox JV, is meant to build out a new defense and security hub. The expectation is that Nuburu is morphing from a niche hardware company into a diversified defense contractor. This is the kind of story that can capture the imagination of the self-investing community. But the reality of this stock's movement is pure, unadulterated speculation. The volume is enormous, often trading tens of millions, sometimes hundreds of millions of shares. This isn't Fidelity Wealth Management allocating capital for Fidelity IRAs. This is not the kind of holding you'd find in Schwab Intelligent Portfolios or broad Fidelity ETFs. This is rapid-fire trading from retail and day trading desks, people using interactive brokers' high-speed platforms to scalp pennies, all betting on the next press release. The stock's 52-week range from 0.12 to just under $1 tells you everything you need to know about its stability. It's a trading vehicle, not a long-term compounder like Apple stock or Nvidia stock. Now we have to establish the ground floor. We have to look at the reality that this entire defense pivot is being built upon. And frankly, it's terrifying. If you were to open an individual brokerage account and look up Nuburu's actual financials, you would not believe it's the same company from the press releases. Let's talk about the core business, the one that this new hub is supposed to replace or augment. For the 12 months that ended on June 30, 2025, Nuburu reported total revenue of just $9,300. That is not a typo. $9,300. This was a 98.68% decrease year over year. In that same period, the company's net income was a loss of $37.69 million. The cash position is even more alarming. As of that last report, the company had only $111,090 in cash. This is not a company with a war chest. This is a company that is running on fumes. The most critical piece of information, the part that gets lost in the excitement of a 17% gain, is the going concern warning. In its financial filings, the company has stated that there is substantial doubt about its ability to continue operations without additional funding. This is an auditor's formal declaration that the company may not be able to pay its bills and could be bankrupt within a year. So when you see this new Maddox JV and the Orbit acquisition, the reality is that these aren't just growth initiatives. They are desperate attempts to create a new story, a reason to raise more capital, which is the only thing keeping the lights on. And how have they been raising that capital? By diluting existing shareholders. In September, the company announced a $12 million public offering, and this isn't the first time. Over the past year, the total number of shares outstanding has grown by an almost unbelievable 1,793.6%. That is massive, crippling dilution. To even keep its stock listed, the company had to perform a 1-for-40 reverse stock split back in July 2024. This means for every 40 shares you owned, they were consolidated into one. This is a procedural move to get the stock price back over $1 to avoid being delisted by the NYSEAMERICAN exchange. It's a clear sign of a company in deep, persistent trouble. This is why the institutional ownership is practically non-existent. The general public owns over 94% of this company. Major institutions, the ones that manage Fidelity mutual funds or provide investment help through structured portfolios, own less than 1%. Vanguard and Geode are listed as holders, but their positions are minuscule. The professional online investing world has looked at the balance sheet and stayed far away. This leaves the stock entirely in the hands of retail speculators, which is why it can jump 17% on a news-driven dream. There are no fundamentals to anchor it. It trades on pure sentiment. Even the company's recent history is shaky. On October 13th, it received a warning letter from the NYSEAMERICAN for failing to provide the required advance notification before it announced its new dual CEO structure. While the company resolved this compliance issue by October 16th, it points to a level of procedural sloppiness that is concerning for a publicly traded entity trying to execute such a complex turnaround. So what was Nuburu supposed to be before this dramatic pivot to defense? The original story, the one that brought it to the public markets, was actually quite compelling. Nuburu is, at its core, a blue laser technology company. It designs and manufactures high-power, high-brightness industrial blue lasers. This is genuinely interesting technology. The fundamental physics are that blue light is absorbed much more efficiently by metals like copper, aluminum, and nickel than the infrared lasers. This means their technology can theoretically produce higher quality, faster welds with fewer defects, which is a significant deal for manufacturing in e-mobility. Think welding copper battery components, electronics packaging, and 3D printing. The original expectation was that this superior technology would be adopted by manufacturers of EV batteries and consumer electronics, disrupting the industrial laser market. But as the $9,300 in revenue clearly shows, that adoption simply did not happen. The market reality was that they failed to commercialize this technology at any meaningful scale. So, the company is now trying to bolt its laser tech onto a new defense-focused business model. The Maddox JV press release mentions synergies with the core blue laser platform, but the focus is clearly on the drones themselves. This brings us to the future outlook, which is a binary gamble. This is not a stock for someone looking for investment help to build a retirement portfolio. This is a lottery ticket. There are two and only two possible scenarios from here. The bull case, the one that the 17% jumpers are betting on, is that this transformation plan actually works. It's a high-risk, high-reward bet on the new management team. In this scenario, the Maddox Defense JV is legitimate. It uses its new European base in Italy to secure real NATO-authorized contracts. The $100 million revenue projection, while incredibly ambitious, starts to look achievable. The Orbit SA acquisition begins generating consistent revenue. The company successfully uses its stock, which is now propped up by this new defense